Hey everybody, Marty Mazzora. Good evening. It's the 9th of April 2025. We'll call this a midweek update, but I'm going to keep it super quick. But couldn't let today go by without shooting at least another quick commentary for you. As I'm sure all of you noticed, the market had a record up day today. Now, of course, I've been warning, for lack of a better term, the last week or so that we were going to get this, that we're going to get some insane, breathtaking rallies in the market. Did I think we'd have this big a rally? Can't say that I did. History doesn't support quite this much all in one day, but nevertheless, it does support, as I illustrated for you yesterday during bear markets, is when you get the best upside days, largely because of the underlying dynamic that really characterized today, and that is just massive short interest in the market. People who were making big bets that the market was going to continue to fall. Therefore, they were short securities. That means they had borrowed and sold, and are obligated to buy back at some point in the future. Now, of course, they're anticipating that they're going to sell at a higher price than what they would have to buy it for to give the shares back to their lenders and pocket the difference. Of course, buying back is not negotiable. They do have to ultimately buy those shares back. So if the market goes up, they could end up buying them back at a much higher price and losing, in some cases, a critical amount of money. So what it essentially amounts to is what's called a short squeeze, or a short panic, or massive short cumbering rally. From what I understand, the market had record short interest embedded in it right here. We also know, and I think I've mentioned this already, that the market is massively or historically leveraged as well. So that would be margin debt, leveraged ETFs, massive option speculation, and so on. And it's in heavily leveraged markets where you get heavy volatility, indeed, in both directions. Okay, so we know what spawned that today. It was the president's announcement that the tariffs that were announced last week and just put in force, I believe, yesterday or at midnight last night, are going to be delayed, or a good percentage of them are. But there's more to it than meets the headline eye, if you will, much more. I want to give you those numbers here and have us thinking about what really went on today and maybe what it does imply. Does it mean that, the worst is over and we're going to get right back to all-time highs and continue this expansion in this bull market? Or are the fundamental underpinnings of this market still very sketchy or concerning, and still, telling us that despite today's massive rally in stocks and despite what was said, that we should not just abandon all caution and just act as if we think it's nothing but blue skies ahead? So a couple things around that. So first of all, it is very bullish in that it does imply that the powers that be indeed do care about the stock market, to the point where they will abandon or delay or lessen the impact of what would be market negative policies in the near term. That clearly happened today. I think the president said he did it because people are beginning to get scared. I believe that's almost verbatim. So again, what does it imply? It implies that the powers that be will come rushing in. Now, what did I say yesterday when I was showing you how we should measure the potential downside in a bear market that occurs during recession? I said that I think a new precedent has set, and I think the powers that be will come barreling into this market before we get to that, what would measure to be as much as a 50% downturn. And of course, the question is whether or not they can actually rescue the market, or are able to apply all of the firepower that would be necessary in what remains, I think, probably a structurally inflationary environment, which is different than what the 2020 backdrop was, meaning back then, at least initially, you could throw $11 trillion into the economy through fiscal and monetary stimulus. That's not what we're dealing with here. We're dealing with interest rates that are much higher, and an inflationary regime, for lack of a better term, that is much stickier, and I don't think would take a whole lot of juice to have it resume its march higher at a rate that would be unfriendly to consumers and ultimately, you could argue, to the economy as well. But again, just to be redundant, it does show that there is a level and a degree of pain and fear that will inspire the government to offer some market-friendly rhetoric, policies, change of policies, and so forth. So with regard to what really went on today, the president essentially said that for nations who are not retaliating to our retaliatory tariffs, the tariffs will be lowered to 10% for the next 90 days. Now, again, that's still in addition to the tariffs that have been implemented earlier on industrial metals and automobiles and so forth. Those are still there. Also, what occurred today was because China did retaliate, the president increased the tariffs on China literally to 125%. Now, here's the rub, and this is not small. Make no mistake. The market rallied on this notion that the import tax, the tariff, are going to be reduced for the next 90 days. Well, increasing China to 125% because of the enormity of the amount of trade we do with China, that actually, on net basis, makes the overall level of tariffs actually more than they were on, quote, Liberation Day the other day, and that were just implemented. I believe it was midnight last night. To be exact, the total tariff rate weighted by import value went from 21% to now 23%. So at the end of the day, folks, that increase in tariffs on Chinese goods more than offset the reduction and increase for the next 90 days. So will the market wake up to that and react to it? Time will tell. Even with that reality, the fact that the president said what he said today is reason to be near-term optimistic that the powers that be will step in. But that's something that I virtually promised would happen yesterday. And I also told you that on our way down to some level that they just can't truly stomach, we are going to see these massive rallies on news of phone calls, news of negotiation conversations, and so on and so forth. So, folks, that's really the newsworthy dynamics of today. The market rally was largely a short covering affair. From a just very simple technical perspective, you can see the chart of the one-year daily S&P 500, again, that bear flag that went even beyond. When we go back to the bottom intraday, day before yesterday, and we retrace that, and you think, okay, if we get this rally, if it's a bear market rally, how high should it go? Well, the first stop is typically the 38% retracement, which is what happened up in here, and it coincided with the 200-day moving average. So that was really stiff resistance that the market couldn't push through. So 38.2, 50, and 61.8 are the key retracement levels. Some technical analysts, that's all they trade on, frankly. And the 50% is a big one. A lot of them will just put orders right there to sell at a 50% retracement. You can see it just nearly nicked it right here intraday and closed a little bit lower than that. It doesn't mean that more good news or good rhetoric won't follow tomorrow and we won't burst right through there. But that'll be interesting to see at that roughly 5,500 mark and the 50% retracement from this, we'll call it a correction so far. The other thing technically worth looking at is the green line here is the 50-day moving average. It is rolled over decidedly, and that is not a good indicator about what the go forward is going to look like. And the 200-day moving average is actually beginning to roll over as well. There's a term for when the 50-day drops below the 200-day. It's called the death cross. You go back and look at it historically, which I have many times as they occur. It's not so bad. It certainly is not as bad as it sounds. A lot of times, 12 months later, the market's done okay. It's during recession bear markets when it happens that typically the worst is yet to come. So we don't have a recession yet. I keep talking about recession, and we're not officially in one. I'm just speaking to what the data are beginning to point to and what we're looking at. A lot of that soft data, sentiment surveys and so forth. And what we're hearing from, again, business sentiment. And if what's been evolving lately continues, we're going to start seeing earnings downgrades. And we're already beginning to see companies issue warnings about how 2025 is going to look. Not as good as they anticipated, say, just a few months ago. So folks, we'll get deeper into the weeds of the technicals, and we'll go back to the longer-term charts and so forth. Let's just let this current volatility play itself out. I'm not complaining. We had a very good day in our core portfolio. We've been anticipating, a massive rally. Typically, they go more than a day. Therefore, we tactically put on some upside exposure using call options effectively to offset what our put options, which have been incredible of late, would decline by if indeed we got these rallies, which we fully expected. So we were able to therefore capture a good chunk of today's rally, certainly relative to the overall risk we're taking and the amount of diversification and liquidity that we have in the portfolio. So folks, let me just simply leave it there because I'm coming at you a lot of late, so I probably should keep them somewhat short because some of it's going to be redundant, and right now I'm just interested in just kind of passing on to you how we view these developments as they continue to unfold. Thank you as always for watching and listening, and I'll be back very soon. Take care. Bye-bye.